Hello everybody. This is lesson 4 of the lecture International Financial Markets. I will discuss slides 1 to 20 of chapter 2, Major Markets and their Assets. Before we start, let me give you a short overview of chapter 2. In this chapter I will talk about the biggest market segments of financial markets: the credit market, the stock market, the foreign exchange market, and the markets for basic derivatives. We will see how these markets evaluate the prices of the major assets traded there and analyze some interactions between these markets. We will start the lesson with credit markets. A range of quite different securities are traded on credit markets. The asset type we will talk about are securities with fixed rates, which bear a fixed rate coupon, which guarantees a fixed annual payment of interest over the maturity of the security. This is the most common type of a credit market asset. A lot of names are used synonymously for fixed rate securities, like notes with fixed rates if issued by companies, bonds with fixed rates if issued by governments, straight bonds, plain vanilla bonds, or gilts. Another asset class that plays an important role on credit markets are securities with floating rates. They pay interest rates which vary during the life of the security according to typically short-term reference rates or inflation indexes, for example. Another group of assets traded on credit markets are equity-related securities. They carry an equity element in the form of a conversion clause or warrants to acquire stocks of a certain stock company, typically the stock company that has issued these securities. Securities with money market instruments are securities with maturities up to 1 year. Their market segment is somewhat ambiguously called money market. So we will focus on the first group of fixed rate securities, which represent the largest market segment on credit markets. For simplicity, we will call these fixed rate securities bonds. They are contracts that guarantee their owner a payment of a fixed annual rate of money plus the payment of the face value at the end of their maturity. They are typically issued by governments and to a smaller part by large firms. Before the day of issue, the issuer publishes, for example, the following kind of information. Fixed rate interest rate represents, for example, 5% of the face value. The face value is the redemption price, the price at which the issuer takes the bond back at the end of its maturity. Let's assume that the face value here is 100 euro. And finally, the periods to maturity. Let's assume that in this case, this is a period of 4 years. As the empirical evidence shows, the market price of such a bond corresponds typically to the present value of all future payments the bond provides. In this example, it is €5 in every year until its maturity, and in the last year the bond is taken back by the issuer, so we got additionally €100 face value. The discount rate at which markets discount this payment flow equals typically the market interest rate for bonds with the same maturity and the same risk class. In this numerical example, this interest rate is equal to 4%. Since this interest rate is smaller than the yearly interest payments of the bond, which are equal to 5% of the face value, the resulting present value is larger than the face value of the bond. The resulting market price of this bond at the day of issuance would be €103.6. According to the standard market terminology, this bond is sold with agio, since the price is higher than the face value. What is the role of the market interest rate here? The higher market price, the agio, causes the internal rate of return of this bond to fall below its fixed rate and to equal the market interest rate. In this numerical example, the market interest rate is 5%. Since this interest rate is equal to the yearly interest payments of the bond in percent of the face value, the resulting present value is equal to €100, the face value of the bond. According to the market terminology, this bond is sold with pari. In this numerical example, the market interest rate is equal to 6%. Since this interest rate is larger than the yearly interest payments of the bond, which is 5% of the face value, the resulting present value is now smaller than the face value of the bond. It equals €96.5. According to the market terminology, the bond is sold with disagio. Why does the market price of a bond moves, as we have seen, inversely to the market interest rate? The higher the market interest rate, the lower the market price of the bond, and the lower the market interest rate, the higher the market price of the bond. The numerical example shows that the lower market price causes the internal rate of return of this bond to rise above the fixed rate and equal the market interest rate. Why does the price of a bond always adjust so that its internal rate of return equals the market interest rate? The adjustment is made by market forces, that is, movements of supply and demand. If, for example, the internal rate of return of a bond is higher than the market interest rate, people would buy this bond only. As a consequence, this increase in demand causes the market price of the bond to grow until it reaches a level where the internal rate of return equals the market interest rate. If the market rate of return of a bond were lower than the market interest rate, people would not like to buy this bond. As a consequence, the lack of demand causes the market price of the bond to fall until it reaches a level where its internal rate of return equals again the market interest rate. So this is the economic explanation for the inverse relationship between market price and market interest rate of bonds. Let's now talk about the risk profile of bonds with fixed rates. If you buy a fixed rate bond and keep it to the end of maturity, you will receive an ex-ante fixed return plus the face value. Consequently, the internal rate of return is fixed. If you keep your fixed rate bond to the end of maturity, the only risk involved in this bond is the default risk of the issuer. There is no return risk. Therefore, fixed rate securities of different issuers are bonds of different default risk. For example, government bonds, corporate bonds are the most important bond classes, and their risks deviate. Therefore, fixed rate bonds of different issuers typically bear different yields to maturity. This is the so-called risk premium, which we have already discussed in chapter 1. This diagram compares the yearly returns of German government bonds with the yearly return of German corporate bonds. On average, the return of corporate bonds is higher than the return of government bonds. So the red line here lies typically on a higher level than the green line, which represents German government bonds. This can be explained by the higher risk of corporate bonds. Private companies can go bankrupt, while it is much less likely that the German government will go bankrupt. Consequently, the default risk of an investment in corporate bonds is higher, and the risk premium has to be paid as a compensation. So if you keep a bond until the end of maturity, you only have to bear the default risk. However, if you sell your fixed rate bond before the end of maturity, you may receive a market price for your fixed rate bond significantly lower than its face value. Consequently, selling a fixed rate bond before maturity involves a price risk. Why is it possible that the market price of a fixed rate bond decreases before the end of maturity? Demand and supply on the market for fixed rate securities may have changed since you have bought your fixed rate bond. For example, supply of fixed rate bonds with the same maturity of yours may have grown faster than demand, so that prices may have declined. This diagram displays the demand for fixed rate securities, which is credit supply. Demand for bonds supplies credit to the bond market. The green line is supply of bonds, which represents credit demand, because issuers that sell a bond demand a credit. Let's assume that the diagram represents the market for bond with maturity of 4 years. If at the date of issue the fixed interest rate of this bond equals the market interest rate, which in this example here is 5%, The market price of the bond at the day of issuance equals 100 euro. It's equal to the face value of this bond. We've already checked this relationship. Now let's assume that 1 year later the demand for credit in the market segment with a maturity of 3 years has grown, such that the market interest rate is no longer 5%, but we take the new intersection point, 6%. If you apply now a discount rate of 6% to calculate the market value of this bond over the remaining 3 years, the market value falls below the face value to a price of 97.3 euro. If you have to sell the bond in this situation, you will hence suffer a loss compared to the buying price of 100 euro 1 year before. Of course, this decrease in the market price is only a disadvantage if you need to sell your bond before its maturity. Only in this case you will suffer from price risk. If you hold your bond until the end of the maturity, you will get back all your money plus the fixed rate of return as promised at the date of issuance. Consequently, if you cannot be sure whether you need your money back before the end of the maturity of a bond, don't buy a bond with a fixed rate return, else you will suffer a price risk. If you cannot be sure whether you need your money back before the end of the maturity of such a bond, you better buy a security with a floating rate or a similar instrument. To sum up, the market price of a fixed rate bond does always adjust so that its internal rate of return equals the market interest rate. If the market interest rate increases, the price of the bond decreases. If the market rate decreases, the price of the bond increases. As a consequence of this behavior, the market price of a fixed rate bond can display a high variance and hence a high price risk. However, the holder of a bond suffers from this price risk only if he sells the bond before its maturity. If she keeps the bond until its maturity, she gets the promised face value as well as all the promised interest payments back. Given the negative relation between the market price of a bond and the market interest rate, what deal would be profitable if you receive information that market interest rates will fall? Well, if the interest rates fall, the market price of bonds will grow. Hence, you could make a profitable deal if you buy bonds today at the higher interest rates and sell the bonds when the interest rate have fallen. In this case, you would buy at a low price and sell at a high price, so the price difference would be your profit. What would happen in the other possible case? You receive information that market interest rates will grow. Well, if interest rates grow, the market prices of bonds will fall. Hence, you could make a profitable deal if you lend bonds from a bank, for example, and sell them today. When the interest rates have grown, you can buy the bonds back at a lower market price and hand them back to your bank. In this example, you would sell at a high price and buy back at a low price. And again, in this case, the price difference is your profit. This is called going short in bonds. So much for this lesson. In the next lesson, we will talk about stock markets.